Hello dear students, my name is Dr. P. Zada Mohammad Oas. Today we are going to take the subject security analysis and portfolio management. So first thing is that we will see what's security and security analysis and what's portfolio management and in what relation we are learning this subject. So first thing is that so this subject is in relation to the stock market. So we are, as you know, the activities related to the purchase and sale of securities, purchase and sale of shares or debentures is happening in the stock market. So this subject we are having this subject and we are learning this subject in relation to the stock market. So first thing we will see that security means whatever the instrument, whatever the we can say the share which is being traded in the stock market or which is being traded in the stock exchange is called the security. So that security is being traded in primary market as well as in secondary market, that we will see in the later slides. So first thing is that whatever the instrument which is being traded in the stock market is called the security. So when that security uh, that's being traded in the stock market has to be purchased by the investor, so some factors we have to see, and the main two factors we are seeing is the risk and return of that particular security. So how we are seeing this risk and return of that security, we have to analyze the we have to measure the risk and return of that particular security. So when this analysis we are doing, when we are seeing the risk factors, when we are seeing the return factors of that particular security, that portion, that thing is called the security analysis. So through this analysis we will come to know whether we are going to purchase this security or we are going to sell that particular security, or we don't have the option, or we don't want to purchase that particular security. So that's happening, that's possible only when we are analyzing that particular security, and that's being seen through risk and return. Now the third portion related to this subject is the portfolio management. As you have seen, the first thing is that we have seen the security, we have seen the security analysis. Then the third portion is portfolio management. So when an investor is investing in one company, for example, an investor has purchased the shares of one company, for example, an investor has purchased shares of State Bank of India. So in that case we can say the investor, that particular individual is the investor, he has invested in particular bank or in particular security. But when the same individual is investing in different industries, in different companies, in that case we can say he has purchased the shares of different companies. For example, he has purchased the shares of State Bank of India, Punjab National Bank, or we can say from the another industry like FMCG sector, he has purchased the Hindustan Unilever Limited shares. So in that case, when an individual is purchasing the shares of more than one company, or when the individual is purchasing the shares from different companies, we can say that's the portfolio. He is making the portfolio of particular securities. So in that case he has to manage that portfolio. Every time he has to look after that portfolio whatever he has made of different securities, because this portfolio management is very important. When he is seeing that portfolio only, then only he will come to know which security is fetching very good return and which security is not giving the good return, or which security is having the losses. So on the basis of that only he has to manage that portfolio. He has to purchase some other shares and he has to sell some shares from the portfolio. So this is the thing related to this particular subject, security analysis and portfolio management. So moving forward, the first module here we have to see in this particular subject is the investment and risk return. So first we will see the investment, what's investment and where from this investment is coming. So first thing is that if you can see, every individual is doing some activity in his day-to-day life. So that activity is giving that individual the we can say the value for that particular activity, or we can say the wage or the salary an individual is getting, or we can say whatever the activity he is doing, he is getting some return from that activity. For example, we can take the example of salaried person. An individual is getting the salary every month, so in that case he is getting some money every month, and he is having some expenses during that month. So whatever the expenses are there, when we are deducting those expenses from the return, whatever the he is getting the salary, so some idle money will remain there. So that idle money will remain with that individual, and he can make the savings of that particular returns, particular money, whatever he is having the idle money. So those savings will not fetch any return to that individual. He can make the savings in particular bank deposit, or he can make the savings in post offices. So in that case, the savings, whichever whatever the savings he is making, will not fetch the return, good return to that particular individual. So in that case, the investment is coming into the picture. So when that particular individual is investing the same amount of savings, whatever he has made the savings in different avenues, when the individual is investing that particular amount of savings in different avenues, so it may be stock market, it may be some other avenue like we can say the real estate, or it may be some avenue that he has started some business. So in that case, the investment is happening when we have the idle money. That idle money is turning into the savings, and that saving is turning into the investment. So now we have to see what's this investment. So first thing is that this investment, we can say, this is the sacrifice of certain present value for uncertain future reward. So in simple terms, we can say the certain present value is like whatever he is having in his hand or he has saved in his life, he has to invest that. He has to sacrifice something. He has to take that money from his bank account, or he might have kept it somewhere. So he has to take that money, and that money is having some present value, and that's certain that the value is there for that particular amount, and he has to sacrifice that. He has to put it somewhere so that he may get reward in the future. But the value is there, and that value is certain. That means there is no uncertainty in that. That is the actual picture there in present. So he has having the certain present value with whatever the money he is having, whatever the savings he is having, those savings are having some value. But he is going to get in future reward, and that reward is uncertain. That means that individual is not able to know whether he will get the reward in the future, and that reward will be positive or it will be negative, whether he will get the return from that particular investment, or there is risk he may lose that particular investment. So in that case, we are saying that he is making the sacrifice in the current present value. He is having the sacrifice, making this sacrifice so that in the near future he may get some reward. He is having the hope that he may get some reward when this investment, when this money, when this savings are being invested in some avenues which may fetch the return to that particular individual. So we can say, in other words, it's the postponement in current consumption. Like he has made the savings, he has spent some amount of money from the salary. So that amount of money, whatever is being left, that means which has been kept aside for savings, so he has postponed something. So current consumption, he has reduced the consumption, so that he has postponed the consumption, so that there may be some savings, and those savings should be turned into the investment which may get the benefit for the future. Or we can say the investment is, in simple terms, we can say it's the employment of funds. We have to put somewhere these funds, whatever we have saved, on the assets, on some assets which may get a good income and capital appreciation. So two things are coming here when we are making the investment. Two things are coming into the picture, that an investment can give two earnings to an individual, and one is regular income to that particular individual from these investment avenues. And another thing is that capital appreciation may happen. For example, we can say that every month an individual was saving 1000 rupees, so 1 year he may get 12,000 rupees. So that 12,000 rupees he is investing in the stock market, and when he is investing in the stock market at the beginning, he is investing 12,000 rupees, what he has made the savings, and during this whole year he is getting the dividend for that particular investment, as he has purchased the shares, and those shares are getting the dividend of 500 or 1000 rupees every year. So every year he is getting this income, that means 1000 rupees or 500 rupees, so that's the regular income. And after 3 years or 4 years he is selling those securities, he is selling that investment, and he has purchased that investment for 12,000 rupees, and after 2 years or 3 years he is selling that investment, he is selling their securities at 50,000 rupees. So whatever is the difference between 12,000 and 50,000 has become the capital appreciation. So two types of earnings an individual can get from this employment of funds from this particular investment. One is simple earnings and another one is capital appreciation. And one more thing is there, that whatever the investment an individual is making, that is certain that he has to make this investment, he has to spend some amount and he has to invest it, he has to postpone from the current consumption, then only he will be able to invest it somewhere, and that is certain. And the return which he is expecting to get in the future, because future is uncertain, we cannot predict the future, so whatever the return has which is going to come to that particular individual is uncertain. So in that case he may get some return also, he may get positive return also, or he may get negative return also. So this is the first thing related to the investment. Now things are there like in stock market. So we are saying that there are so many types of people who are dealing in the stock market. So there are investors who are doing the investment in the stock market, there are speculators also who are doing the speculation in the stock market. And those people, when we are talking about the investment and speculation, we have to see here in this case the difference between the investment, and we have to see the difference between the investment and the speculation. So first thing is that uh, in this case we are saying that the first, we can say, the basis on which the this differentiation has been made, this distinguish these terms have been distinguished. The first base is time. On the basis of time, we can say the investment has to be made for the long year, that means for beyond 1 year. But when we are talking about the speculation, the speculators who are dealing in the stock market, what they are coming for the shorter period, or sometimes for a single day also. For example, in the morning they may purchase the shares and in the evening they may sell those shares. But in terms of investment, this thing is not happening. Investors have the motto that they have the vision that they have to come to the stock market to earn the regular income, as well as the capital appreciation should happen. So those people are coming for the longer period, for example beyond 1 year the investment they are making. So another factor is risk factor. So in terms of investment, because it's for the longer period of time, the risk is low in terms of investment. But in terms of speculation, the risk is very high, because during the whole day they have to deal the transactions, they have to purchase the shares, they have to sell the shares in one day itself. So there are chances that the risk is too high. For example, there are chances that in the morning they have purchased it at a very high low price, and in the evening they have to sell at a higher price. So in that, return is high. Or in other words, we can say they have to purchase in the morning at a very high price, and in the evening the price was very low, so in that case the risk is very high. Same way the return also, if you can see in investment, the moderate return where the individual is getting, the investor is getting. But in terms of speculation, high returns are there. So wherever the high risk is there, so the higher returns are there. So more the risk, more the returns are there. So that's possible in speculation only. Then one more thing is their use of funds. So investors mostly use their own funds. Like I told you earlier, also they are taking their savings and they are investing those savings in some shares or purchasing some stocks of different companies. But in terms of speculation, mostly the people are doing, only few people will be having their own money. Mostly the people will borrow the money and they will do the speculation, and this is happening for the shorter period, so that's why they are borrowing the money from other parties. The factors which are being considered in both the things, if you can see in terms of investment, when an individual is investing some via his savings, so he may look at different things like factors which he is looking at. First thing is that he may look at the safety of his investment, then the liquidity of his investment, then the profitability of his investment, then the stability and performance of the company. So these factors an investor is looking at before investing somewhere, that he has to see, he has to ensure that his savings, his investment is safe, it is easily liquidated, easily he can liquidate, it's giving the profit, it is having the profitability is there in the company, stability and performance of the company. So all those things the investor is checking before investing in some particular stock. But in terms of speculation, the speculators are not looking at this information. They have to see the information related to the judgments and movements of the stock market. That means they will see the previous days, and on the basis of that they may invest, they may speculate in the stock market. So the next thing is basis of decision. So in terms of investment, mostly the investors are focusing on fundamental analysis. They are focusing mostly on fundamental analysis, but sometimes the technical analysis is also being utilized or followed in investment purpose. But in case of speculation, speculators have nothing to do with the fundamental analysis. They are not looking at the fundamental factors like economic analysis, industry analysis, company analysis. They have nothing to do with those things. They will focus on the technical analysis portion only. That means they will look at the charts and graphs. On the basis of that only they will decide whether they have to speculate in the market or not. Then the last factor is last base is the psychological attitude. So in terms of investment, the investor will be the cautious and conservative, because he has invested his own money, he has to put his money for a longer period. So in that case he will be somewhat cautious as well as the conservative. But in terms of speculation, those people, they have to do the business, they have to speculate in the market for one day or for few hours only. So in that case they will be, they are the behavior, the attitude, the psychological attitude of those individuals who are speculating in the stock market will be careless as well as daring, that they are having the guts sometimes to get huge amount of money in terms of returns, or sometimes they may lose their whole amount of money. So the risk is high. In that case the behavior, the attitude of those individuals is daring and careless. So as the first thing we have seen in relation to the investment and speculation, so there is one more thing, investment and gambling. So we are comparing the things related to the investment with the speculation with the gambling. If you can see in gambling, it's like there is nothing planned. But if you can see in terms of investment, the first basis you can see the nature. The investment, what whosoever is investing in some stocks, he is planning carefully and scientifically each and everything. So everything is going pre-planned. On the basis of that only the investment is being made by that particular investor or individual. But in terms of gambling, nothing is planned and everything is unscientific and unplanned. That means in gambling, an individual can come anytime and he can gamble in the market. If you can see the risk and return factor with investment, risk match with return. So if the risk is there in terms of investment, it will be in relation to the return. That means it will not go beyond return or it will not go below this. So in that case, the risk may match the return. So whatever will be the return, the risk will be that much only, or the risk will be very less than the return. So this is the case in terms of investment. There are very rare chances that the risk may go beyond return. That means risk may be more than the return. But if you can see in terms of gambling, the thing is that the people who are taking higher risks, they will get the higher return in terms of gambling. So that's not possible in investment. That's possible, but very few people are having that behavior, because they have to be in the stock market, they have to be in the market for a longer period. But the gamblers have to do these things for only few hours or for few days only. The motive for investor is that they have to go for regular income as well as the capital gain. So in that case, the investors have the motive that they will get the regular income as well as the capital gain. Two types of incomes will come from this particular investment. But the gamblers have nothing to do with the income capital gain. They will do it for the thrill and excitement. So sometimes they will be having a different mode. So in that mode they can go for this gambling. They will do the gambling in the market. So that's for thrill and excitement. So they are very excited. In that case, they may go and gamble in the market. The period for investment is longer period, but in terms of gambling it's very short period. And the action, so in that particular investment, the detailed analysis is being done. On the basis of that detailed analysis, the investment is being made, and any action is being taken on the basis of that particular analysis. That means we have to purchase or we have to sell the shares. That is, the detailed analysis is happening before that. On the basis of that analysis only action is being taken. But if you can see in terms of gambling, only tips and rumors are there, and on the basis of those rumors only the things are happening. The people are gambling in the market.